Welcome back to Alpha Recap, your after-hours market wrap from stockalpha.ai. We were recorded after the close today, and if you have questions, you can reach us at stockalpha.ai. Ready to dig in?
Absolutely. Lots to unpack from a pretty mixed day in the markets. Markets closed mixed after some profit-taking in big tech and a cautious outlook from Walmart.
Right, so what really stands out here is that the day wasn't driven by one big macro print. It was a cluster of sector stories that together sent a clear signal about structural change and near-term risk.
Totally. And the three that jumped out were consumer remix, think footwear, AI adoption and software, and then a classic earnings story where a beat still got punished. They all sort of tugged the market in different directions.
Let's start with the consumer piece. New Balance, a private company, reported about a 19% sales surge to about $9.2 billion in 2025. That was the single strongest demand data point of the day.
Yeah, that tracks. For a private brand to grow that quickly and to be stealing share from incumbents, it signals cultural momentum. Streetwear, the dad shoe trend, plus tight distribution control.
Analysts specifically called out share gains versus Nike, and that's where the market paused. I mean, when you step back and look at this, it's a reminder that scale isn't everything. Brand positioning and speed matter.
Exactly. For investors in public consumer names, the implication was clear. Watch retail inventories, supplier reorder patterns, and how Nike talks about mix and promotions next quarter.
And if you're a supplier or a factory owner, this is the kind of signal that would make you rethink capacity allocation. Shift more to the brands that are actually gaining cultural momentum.
Short reaction. Big for footwear.
Moving to tech, and specifically AI and software, we had a concrete data point from Amplitude. Management said AI agents now accounted for 25% of platform queries, and they laid out a 15% revenue target for 2026.
That was actually one of the cleaner AI signals we saw this week. Usage quantified, 25%, tied directly to a revenue target. It's not just demo day hype anymore.
Right. And the other thing is usage versus monetization. Higher query share is great, but the market really wanted to know, will this convert to higher average revenue per user or lower churn?
That's the million-dollar question. Some investors are bullish. They say more engagement naturally leads to expansion ARR. Skeptics point out that SaaS companies often need contract resets or premium tiers to capture that value.
Quick explainer for listeners. Expansion ARR is basically the extra recurring revenue you get from existing customers when they buy more features or higher tiers. If AI just increases clicks, that's usage, not necessarily revenue.
So for Amplitude, the watch list is straightforward. Net new ARR, expansion ARR, and churn in the coming quarters. Those metrics will tell whether AI usage is translating into dollars.
Short reaction, watch those KPIs, right?
Now on to Carvana, a headline quarter that had everyone paying attention. Fourth quarter earnings per share came in at $4.22, and revenue was about $5.65 billion. Big year-over-year jumps, 463% and 59% respectively.
And yet, the stock got punished because management flagged higher costs. Honestly, I was a bit surprised by this one.
Yeah, it's a good reminder that a headline beat isn't always enough. If costs are rising in logistics, refurbishing, and transport, all labor and capital-intensive areas, investors worry about margin sustainability.
Morgan Stanley still called it an attractive risk-reward. So the debate became buy the volatility versus caution on execution risk. Short reaction, swing trade material.
It's one of those stories where if you're a longer-term holder, you want to see consistent margin improvement and clearer cost guidance. Otherwise, it can flip back into a value trap fast.
Let's pivot to capital allocation and corporate housekeeping. There was a smaller but meaningful deal. Depot Connect International agreed to sell industrial and rail services to Clean Harbors for about $130 million. That narrowed DCI's footprint and boosted liquidity for redeployment.
And there were a bunch of 8K filings. IDACorp, WorkSport, Laureate, Atai Beckley, Six Flags, Beta Technologies. Mostly governance, exec changes, and operational exhibits. Those are perfect catalysts for event-driven investors.
Short reaction? Pay attention to 8Ks. Right.
Now, on energy and the decarbonization front, there were two developments that together painted an interesting picture of policy plus project momentum.
First, the European Bank for Reconstruction and Development had a mandate letter for a 342 megawatt project in Serbia. That was 270 megawatts peak of solar, plus 72 megawatt hours of battery storage. Bank-backed financing materially improves the project's bankability.
Second, TerraPower's Natrium reactor got accepted into the United Kingdom's Generic Design Assessment, which is a regulatory de-risking step that you need before you can really build at scale. Together, those moves showed both near-term renewables deployment and longer lead advanced nuclear work.
For listeners new to this, bankability just means the project is in a shape banks and institutional investors will fund. Getting that EBRD backing makes private capital more likely to show up.
So the takeaway for energy investors: diversify exposure across renewables, storage, and supply chain plays for advanced nuclear. Policy and institutional capital were aligning, not just rhetoric.
Let's talk where market participants disagreed. Some of the debates we saw today are going to matter for positioning.
First, valuation versus re-rating on the New Balance win. Some argued that public incumbents like Nike should reprice because this is structural. Others said private company dynamics aren't fully transferable. Distribution control is harder public company dance.
Second, AI adoption. Usage does not equal monetization. Bulls saw the Amplitude number and jumped. Skeptics pointed to the classic SaaS conversion problem.
Third, Carvana. Opportunistic buy or value trap. Morgan Stanley was optimistic. The market focused on the cost signals. Both sides had legit points.
And fourth, macro rotation. Was the pre-open weakness a tactical rotation into defensives after tech profit taking, or an early warning on consumer weakness? New Balance complicated that narrative. Pockets of consumer strength existed even with broader caution.
Which leads nicely into what this meant for different investor types. Growth investors, especially AI and SaaS plays, needed to look for conversion metrics. Consumer investors needed to differentiate winners by brand momentum and channel control.
Event-driven investors should be scanning those 8Ks and small M&A moves for catalysts. Value and defensive investors had a chance to rebalance into cash-generative staples after Walmart's cautious tone, but not throw out cyclicals that showed real demand.
And energy investors got a clear nudge. Track project milestones and regulatory timelines. Those EBRD and regulatory moves were meaningful de-risking signals.
Tactical watch list. Quick and practical. For Nike holders, watch retail inventories and any commentary on mix or promotions. For AI allocations, focus on net new ARR, expansion ARR, and churn.
For Carvana investors, if you swing trade, earnings volatility could give entries. If you're longer term, ask for sustained margin improvement. For income or defensive portfolios, use any rotation to rebalance quality and yield, but don't go all in defensive.
And for energy allocations, follow project milestones. Those mandate letters and design acceptances don't move fast, but when they do, capital follows.
So what was the bottom line? Today was less a single macro pivot and more a cross-sectional repricing. Culture-driven consumer winners, measurable AI adoption in SaaS, and the tension between headline beats and margin reality.
Exactly. The practical portfolio play was to overweight names with improving unit economics and demonstrable conversion. Keep conviction light where monetization was still speculative, and trim overheated mega cap positions if you needed dry powder for redeployment.
Short reaction, differentiated approach wins.
Before we sign off, a couple of crisp takeaways. 1. Consumer markets weren't broken, they were remixing. 2. AI moves from demo to product engagement, but conversion is still the gating factor. 3. Earnings beats can be hollow if execution risk is rising.
And 4. Energy and infrastructure got institutional nudges that matter for the medium to long term. Keep watching project and regulatory milestones over the next 30 to 90 days.
All right, that's our recap. If you want the charts or a deeper note on any of the names we discussed, head to stockalpha.ai.
And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.
See you next time on Alpha Recap.